What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about one stock that is trading very close to its fair value. They are going to be reporting earnings next week. So my goal in this video is to break down exactly what the company does. Of course, go over the fundamentals, the revenue, the earnings, go over the financial summary and the intrinsic value itself. And of course, go over the technical analysis because the stock has been selling off quite aggressively in the last few months. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. There is a 16% annual discount available till the end of this month, and that'll give you access to everything, including a members-only private video I posted yesterday going over 4 trade ideas for everyone to watch and, of course, consider in the upcoming weeks. So all of that is going to be included with the link down below. The company we are talking about today is going to be none other than Target, and Target's earnings are expected to be released pre-market on August 16th. And the EPS is going to be $1.43. Revenue expected at just over $25 billion. We've seen 26 downgrades in terms of EPS, in terms of downward revisions in the last 90 days, only 4 upward revisions in the last 90 days here for the company. As we already know, Target is a very, very strong retailer in the US, one of the largest companies out there when it comes to retail sector. They've been able to grow revenues from $71 billion to over $107 billion, but that growth didn't really accelerate up until 2019, 2020, right? It was after the pandemic when the growth really started to accelerate for Target because they were very, very stagnant up until that point. Gross profit has gone from 21 billion to over 27 billion. Again, you can see that they were kind of going back and forth up until 2019 when they really started growing. Once again, although it has been a little bit lower, then back higher because of the over inventory issues and the fact that, of course, Target did have a lot of employees. They were starting to overhire as well. And as a result, you notice $4.8 billion operating income, growing that to, again, $6 billion, $9 billion in 2022. Last couple of years, significant decrease in that operating income because of that substantial increase in selling, general, and administrative expenses. You can see the SG&A grew from $14 billion to over $20 billion. And the last couple of years, they've just been going up 16, 18, 19, 20.5, 20.7. So almost up to $21 billion. So revenue growing, gross profit kind of a little bit wobbly, so going up and then coming down, and then SG&A also consistently growing, and as a result, operating expenses were going up and operating income was very, very flat, increased, and then back down in the last trailing 12 months. This right here is shares outstanding, a phenomenal share buyback program, so they've been just plowing money into back into the company from 641 million shares in 2014 down to 463 million shares outstanding as of the last 12 months. EBITDA moving in the right direction. However, again, very, very up and down here. So $11 billion EBITDA in 2022, and trailing 12 months is pretty much half of that, $6.6 billion. So substantial decrease in EBITDA. So since 2014, what you will notice is that revenue has not gone anywhere. Like, it's basically grown by about 0% on a compounded annual basis. I just want to make sure that this is indeed right. So if I go over to my intrinsic value here, let's just do that calculation right now. What we're gonna do is we're gonna plug in 2014 revenue because it doesn't seem right. 71,729, 71,279 actually, and then we got 2023 trailing 107.6, 107,706 I think is the number. There we go. So this right here, yeah. So that's the issue, right? It should be E. Right there, 5%. Okay, so 5% has been that growth rate since 2014, not 0%. And then if you take a look at the other numbers, we're gonna plug those numbers in: 21,240, 21,240, and we're gonna plug in over here 21,589, 21,589. Actually 27,118, 27,118. And then we're just gonna bring that over in terms of 27,118. Sorry guys, I'm just kind of doing this right now. That's a 2.75% growth rate in gross profit. Operating income 4879, that's already there. So 4879, we're gonna plug in 2023 numbers, 3953, that's going to be a growth rate. Actually, that's going to be a decline of 2.31%, right? So revenue's been growing, operating income has been going down. Net income here 1971, and that's grown to 2721. That's going to be an increase of about 3.65%. Again, not bad. Free cash flow 8563, and that's grown to a little bit under, actually negative now, so negative $185 million, and that is going to not be able to calculate because of the negative free cash flow. 642, and then 2023 463.5, and we're looking at a negative 1.44% share dilution every single year since 2014. EPS has gone from $3.07 to $4.83, and that's going to be a growth rate of just over 5%. And free cash flow, again, not being able to calculate because of the negative free cash flow, thereby negative free cash flow per share. But overall, as you can see, the growth rate has been a little bit over 4.6% compounded annually and 2.75% in gross profit. Operating income has been declining. Net income has surprisingly increased by over 3.6%, and shares outstanding have gone down by 1.44%. This indeed is actually still true. 8% growth in revenue, 5% growth in gross profit. Operating income, again, gone down. Net income, you'll notice since 2018 hasn't really moved much, right? So 2.9 billion, it's only gone down to 2.7 billion dollars, and shares outstanding have gone down by about 3%, which again is a pretty good number. When it comes to margins, again, Target is a retailer after all, so 25% gross profit margins, net margins at just under 2.5%, and we got very, very reasonable, I would say decent return on capital and assets. Return on equity is pretty good, but other of those two metrics are not that great in terms of that efficiency from the company. Now, balance sheet is another thing that does concern me a little bit for Target. $1.3 billion of total cash with almost $19 billion of debt. And we're looking at a current ratio of 0.88, and quick ratio is really, really poor. And that just goes to show how much inventory they have on the balance sheet. Inventory has been such an issue for Target. They've been marking down a lot of their products, and for those reasons, quick ratio is 0.07, right? That's literally, that just goes to show that inventory is pretty much making up majority of their current assets. If you take inventory out, they don't really have any other short-term assets to cover their current liabilities. So 0.07 is really, really bad. And of course, balance sheet overall is not that great. Valuation-wise, again, 22 times earnings on a trailing basis, forward trading at over 16, almost 17. Price to sales a little bit under 1, and we got price to cash flow trading at 8 to 9 times earnings, free cash flow multiple here. And this right here is going to be that earnings expectation, which is going to be in the mid to high single digits for the company over the long term, growing from 784 to over 1850 by 2033. And if you plug in those numbers over here, we get a growth rate of about 10 to 12% for the long term for Target, and a 3.5% share dilution, meaning that they're going to be buying back shares by about 3.5% every single year. So if you plug in, let's say, a 10% growth rate for Target, right, for net income, 14 times P multiple, which is going to be a little bit lower than 16 on a forward basis where it's trading at the moment. 9.5% discount rate because the company does actually pay out a dividend. So if you come over, just gonna get rid of some of these things here. So if you do come over to the actual earnings for Target, we're looking at a dividend yield of a little bit over 3.3%, right? So 3.3% obviously is a lot better than compared to some of the other companies out there. So for those reasons, I'm gonna keep that discount rate at 9.5%. Margin of safety is gonna be 10%. 3.5% share dilution, and we get down to a fair value of just about $124 per share compared to $131 where it's trading at the moment. So only less than 5% downside potential needed for it to be trading at its fair value. And you can kind of see the different growth rates, different P multiples, and kind of decide for yourself what's going to be that appropriate intrinsic value for Target. One more thing that I want to point out is that if you take a look at the financial summary here, the EPS growth has been pretty low. 6% or 2%, that's been the growth rate for EPS, earnings per share for Target. So analysts are pricing in 10% for the next 5 years, which is a little bit on the higher side, right? So if they're not able to grow at 10%, let's say they grow by 6%, then you're looking at 6%, even if it's the same multiple, then the fair value drops down to $103, right? That's going to be this number right here. If it's 6% at a lower P multiple, let's say 12 times P multiple, then we're looking at sub 90 as the fair value. So a lot of it is contingent on the earnings growth for Target. And right now, analysts are pricing in 10%, which in my opinion is certainly a little bit more on the higher side. So low 100s, I think, would be a lot more reasonable. And the balance sheet definitely is a little bit of an issue for Target as well. So this right here is the overall technical chart where obviously Target's been selling off from highs of 257. It's down over 50%, almost 50%. Sold off, consolidated sideways, was making a little bit of a bear flag, broke down even further on earnings once again. So this right here is when they reported earnings last time. And that kicked off another selling round for Target, dropped another 20%, then started consolidating once again. So earnings expectation, $1.45, revenues of just over $25 billion. 125 is going to be that support right here. I wouldn't be surprised if it does end up retesting those levels. But of course, low 100s are going to be some of those support levels, some of the intrinsic value levels to watch, of course, down to as low as $84, $85. Of course, if the growth rates are going to be lower than what the analysts are pricing in. But resistance is going to stay put at 137, 136, 137. Of course, the lower it gets, the better the dividend yield is going to be for Target. It's still one of the strongest retailers out there, still doing a lot of share buybacks, still able to grow revenues and profit, albeit at a very, very slow rate, but it's still a value stock with a decent yield. Balance sheet's a little bit of a concern. Valuation and the growth rate are going to be unpredictable, meaning they are uncertain at the moment. So for me right now, Target is going to be a little bit of a pass. The only time it becomes remotely attractive is at lower prices, closer to low 100s, sub 100, when the dividend yield is going to go up to over 4.5, closer to 5%, and I'm able to take advantage of a lower price to earnings multiple, lower free cash flow multiple, and the balance sheet is the only thing that's going to hesitate me a little bit from an investment standpoint. So hope you guys enjoyed this video and a complete update on Target. Let me know your thoughts down in the comment section below. Support level is going to stay put at 125 going into the earnings, with the resistance staying put at close to 138. My fair value, 124 is decent, but that's also considering a 10% growth rate. Lower growth rate puts me down to low 100s, possibly even sub 90 for Target as well. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel if you're just joining us for the first time. Link to our Discord, Patreon is going to be down below. So always happy investing. I'll see you all in the next video.